Welcome to the Wealth and Business Podcast, hosted by the esteemed Dr. Daniel Moses, a property investment and wealth strategist, educator, speaker, and founder of the Property Wealth and Business Club. In this episode, we feature Dean Cripps, an award-winning broker from Ramsey and White, specializing in residential, commercial, and development finance. Recorded live at the Wealth and Business Networking event on June 13th, 2024 at the Sanctum Soho Hotel. Dr. Moses and Dean Cripps dive into securing finance for property investments, the latest trends in the finance market, and practical funding options. Get ready for exclusive insights and answers to most of your questions.
I want to introduce to you my very personal friend and a guest tonight who I'm going to be interviewing on stage. His name is Dean Cripps. He has been a financial broker, financial advisor over the last 7 years, because he actually known me for the timeline I've been in property, to be honest. We basically started with the first property transaction, the second, and we do multiple £1 million property projects. He has a background in the military before becoming a financial advisor and broker. Without further ado, can you please join me in welcoming my very good friend, Mr. Dean Cripps from Ramsey and White. Great. We're going to be having a conversation around finance and property finance. So first of all, Dean, for those who don't really know you, you're a guest today at the Wealth and Business event. So just kind of share to the audience, how did you basically started in property and what did you do before property?
Yeah, so thank you. Hi everyone, really nice to meet you. Obviously see some, recognise some faces, and obviously really nice to see some new faces. So I'll start from the beginning. So as Dan already alluded to, I started off in the military. I was in the military for 9 years, went to various places, did a tour, which was really, really good. But in the time of the military, I was doing a few little property investments, in the north, you're buying these little 60, 70 grand properties. The sort of bread and butter stuff that most people generally start with. But obviously, when you're in the military, it's quite demanding, and you can be at various locations, and it's probably quite straining on the family side. So, I wanted to leave the military, but I didn't really know what I wanted to do, which is quite common for people in that situation. Because I was doing property investment, I thought, I could be a broker. I like property. I like being brokering. Kind of goes together, right? So I got qualified, and then I joined Ramsey and White, specialist finance brokerage, and the rest is kind of history. But being a broker for the last, obviously working with Dan for the last sort of 6 years, you really learn as well, and you really meet some really wonderful people in property, and they actually are doing some really wonderful stuff. I got some clients that 71 years old. One of them still buys lots and lots of HMOs, and you ask the question, like, why do you do it? Like, why are you still buying? You don't need to, and people change. Your journey will change as you grow up, as you grow in property. So his reason is he helps people, but he helps the lower class of people and tenants that are struggling. He has a team of 30 that work for him, and that's why he does it. He doesn't need money, but he wants to do it because A, he's given 30 people a job, and B, he's housing 500 tenants in his area that no one else really wants to house. People that may have come out of prison or haven't got the deposit, or anything. But anyway, that's why I've done it, and that's my journey to get here, and I love it. I've been investing since 2014. My first ever deal was a 3-bedroom terraced house in Dartford. Would you believe it? We bought it for 130 grand. We refurbed it. I didn't know what I was doing then, because I was 22 years old, didn't really know what I was doing, just kind of dabbled with it. And then we sold it for 230, and we only held it for like 6 months. We just did a straightforward refurb. Now that property's worth like 400 grand, so kind of, as Dan says, when you look at that, you're like, it's 400 grand, that one. That's a bummer, isn't it? Anyway, but yeah, that's just a quick intro to myself. So again, Dan asked me he said, oh, I'm doing a networking event. I was like, okay, cool. And he's like, oh, I want to do a podcast. I think it's something a little bit different. I was like, yeah, okay, that sounds good. And yeah, he invited me along. So I'm really grateful to be here.
Great. So, by the way, if you do have any questions, in the end, we're going to have an opportunity to have the audience, you can ask your questions. So do take notes, all right? And what you're really going to be hearing during the course of this interview is basically giving you the nitty-gritty about property finance. So, Dean, so let's talk about mortgages first, all right? I want to talk about mortgages. I want to talk about bridging finance. I want to talk about development finance. I want to talk about people who have got equity in their properties, basically sitting down there and don't really know that they actually have money, because I've seen thousands of them, right? You and I have seen many of them as well. So my first question to you is, one of the biggest questions I keep getting a lot of people ask me is, I want to get into property, right? And I want to be a property investor. What is the best way to get in? Should I just go and get a mortgage, or should I just get on the help to buy scheme, or get into the first-time buyer scheme? And I said, no, these are different types of, property finances that are available, because, when it comes to a mortgage, there are different ways that you can actually, see a mortgage in terms of the deposit and what you're able to do with that property. So my question to you is, first-time mortgages for first-time buyers, it's not property investing. So I just wanted you to kind of give a little bit of understanding on how people should see mortgages first before.
Yeah, it's a really good question. So I think really what we got to understand is like, who is the buyer? What is the objective of the person? And if you're working with a new investor, now the question, I don't need to ask this question, but I do because I'm an investor. The question I ask is what's your objective? Like, why are you getting investment? If I ask any of you here, if you're a new investor, the first thing you probably say is money. Okay, so what money? What do you mean by money? Do you want £1,000 a month? Do you want £2,000 a month? Do you want 3,000, 5,000, 10,000? Once you know the objective, and objectives will change as you grow, and each year it can change. But your objective might be, I want to earn £2,000 a month extra. But there's multiple ways of earning that extra £2,000. You can do a flip, make 30 grand a year. Isn't that £2,000 a month? You could go do 5 BORs in Newcastle and 300-400 quid. So obviously, I guess on your question back to mortgages is, well, what type of person is it? How are you going to structure it to work for that situations? Obviously, if you're a first-time buyer buying your first home, there's only, you're just going to go your traditional mainstream high street lenders. But if you're going into investment, I need to know like what your objective is, what the deal is, and what's the outcome. Because without that, you can't have a clear plan. Great.
So I'm just going to paint a case scenario here. So I met an individual who said, I want to be a property investor. All right. And I don't want to get into the help to buy scheme. Then I'm going to rent the property. Is that the right way to actually, be a property investor?
No, I mean, obviously, if you're going on a help to buy, your intention is to live in it. You can't then rent it out unless you get permission from the lender. But if your intention is to let it, you won't be able to do that.
I mean, because it's quite very interesting and very enticing as well. So people think help to buy. So help to buy means obviously you're going to put 5% deposit down sometime, or like now you've got a lot of lenders who are doing 100% mortgages. But people are trying to get through into property using that route, saying, okay, I'm going to be a property investor. I just need to get a 100% mortgage. I'm going to rent that property out. And it takes an educated investor to understand that actually going through that route is not property investing, because you're not permitted to rent that property out, right? Because it's a government scheme. Or people buying ex-local properties that they already live in, not also knowing that when you move into that property, you do need appropriate permissions in order for you to rent that property out. For the first 5 years, you can't remortgage it, correct?
Yeah. I think the recent stats are on the ex-local is it's quite interesting. I think 3 out of every 5 are now landlords. So people that have done the sort of right to buy, 3 out of every 5 are just let out now. So that's kind of the statistic on it.
So what kind of mortgage would be for the first-time property investor? Not a first-time buyer now, but first-time property investor.
You mean as in someone just buying a property just to rent
For
out?
invest, not to.
Yeah, so
Because there is difference, right, between a property investor and a property buyer. Property buyer, we all are property buyers. Who here owns a mortgage for your own house, your personal house? So you could be classified as a first-time buyer using that. But when you're a first-time investor, it's different, because when you're actually using a buy-to-let mortgage to invest in a property, you need what? 25% deposit. Yeah. From the get-go, you have the consent of the bank to renting that property out. So basically, you're leveraging the bank. So
precisely, yeah.
I wanted the audience to know the difference between both, because we have a lot of people still not understanding that when you buy a property for the purpose of living in it, doesn't automatically make you a property investor. All right, but when you buy a property for the purpose of generating an income, then that does make you a property investor. So as a financial broker, I really want, because you're qualified to say this, I'm not, but I really want people to really understand, all right, before we move into basically, because we're going to dive into a lot of different conversations.
You've got two things. You've got yourself, someone's going to buy it to live in it. So it's all about the intention. It's not so much the type of person, it's your intention. So your intention to buy this to live in it. That's obviously, residential. Or you've got your intentions to buy it to invest, i.e. buy it to let out.
Yes.
Obviously, you still get some people that, they'll try and buy a property on a buy-to-let, then refurb it, then try refinance it, and it probably doesn't quite meet what you need to do. You need to maybe go on a bridge, or you need to go on a bridge, but hopefully that kind of helps clear that up. So everyone can be a property buyer, but actually to be a property investor, you just need to go on the right tools or have the right sort of training from sort of Dan's team that will give you the guidance.
Great. So my next question is, what is the best route to finance a property investment property?
So again, it depends on the property and what the intention is, and if it's habitable, if you're buying at auction, you either need to go buy-to-let, HMO, or bridge, or development. Again, it depends on what the property is and what your intention will be.
Can you buy a rundown property with a mortgage? A property that has no toilet, no kitchen?
No, you're not going to do that. You have to go on a bridge. So you're going to need to, get the right finance. If you buy with the right finance, it's easy to refinance. So you buy it on a bridge. Also, this is really low level, guys. So if who here, let's make it a bit more interesting. Who here invests in property? Raise your hands. So a few of you. Okay. Who here is starting out their journey? Investment. Yeah. So there's a few here. So this is probably quite good because this is like the basics. If you're looking at buying a property that's uninhabitable, and you can get like a nice juicy deal on it because it's uninhabitable, it's got pink ceilings and no kitchen, then you're going to buy it on a bridge. And the reason you're going to buy it on a bridge is it's short-term finance, usually up to 12 months, for uninhabitable properties, but you're going to add value. You're going to somehow add value to the property. And the value added, if it's obviously a straightforward property, new kitchen, new bathroom, paint, decorating, electrics, really straightforward. Then you're going to refinance at the market value. That's also the new investors. Some of the experience, you obviously know this at the back of your hand. But for the newer people in here, that's how you'll add value to the property. Makes sense? As long as it's very, very easy usually. Like, you can get a bridge on pretty much anything, as long as yourself personally have got fairly clean credit. Although that's not, you don't need to have clean credit, as in your actual credit rating, your personal profile. You don't need to have clean, but it's better. You get a better rate. We've
spoken about bridging and we've spoken about mortgages now. So let's quickly fast forward into development finance and so other things. So bridging finance, we've explained, it's basically used to bridge the gap of buying a rundown property and then get it remortgaged into a mortgage. So I'm sure most of you in the room might be wondering, what is the difference between both? Who here in the room is actually feeling like, what is the difference between both? How many? Just show of hands. Okay. So let's take that question. What's the difference between both, a mortgage and a bridge? And how can people use it?
So again, it comes back to your question on why you're getting into property, especially the new investors in here. Like, why are you getting into property? Obviously, I suspect it's to build up some form of income or additional income. The quickest way to do that is to either buy properties at auction or buy properties that you can get a good price on. Add value, so you're going to buy them on a bridge. The reason it's on a bridge is because there's no exit fees on a bridge. It's short-term finance, allowing you to buy it, refurb it, flip it. Flipping it means you can sell it on, or you'll refinance at the market value. Okay, so for instance, you might buy a property at 100 grand, you spend 30 on it, it's now worth 200. Refinance at 200 at 75%, it's now 150. So you're using short-term finance to acquire, and then you're using long-term, which is a mortgage, i.e. buy-to-let, and like a 5-year fix or 2-year, whatever, to go onto a term, which is cheaper borrowing than a bridge. Bridge will be about 0.91% per month. A term might be about 5% at the moment.
Thank you so much, Dean, for answering that question. Just before I actually move on to the question around the other types of funding, I really wanted to get more out from the bridging situation. Can I borrow money from anyone in the room and use that as a deposit to fund a mortgage?
A bridge.
Mortgage,
unless it's family, then no. It'd be very difficult. Most lenders won't like it. Unless it's family, immediate family.
So, unless it's a family, so for example, my wife can borrow me money, right?
She can gift you the money.
And gift me the money and can use that money to buy a house.
Yeah.
Okay, so what about a bridge? Can anyone in the audience borrow me money and then I can use that as a deposit to fund a property purchase?
On a bridge?
On a bridge.
Yes. So it's quite common, more the complex bridging, more complex transactions where it's larger value. You'll see a lot of investors, they'll have other investors that will give them loans. Actually, you'll have a loan agreement behind the scenes. So, I might loan Dan 200 grand. The lender might want to see, they want to see where it's come from, but they want a loan agreement. Sometimes you don't need money to get in property. As long as you've got time and skill and knowledge, that's half the battle. If you don't have, the three main things really in property, or the three main things in life, is time, knowledge, and money. Some people have a lot of money but don't have a lot of time. Some people have a lot of knowledge and time but don't have money. So you've got to kind of fit yourself in one of those gaps. Some of you will be in all three of those gaps, or some of you might be on, you have loads of money, deep pockets, you have no time, but you still want to return on that money. So that's why there's a saying I like to use: if you win, I win. So for instance, if Dan does a development and you loan him 200 grand at 15%, he then uses that with a bridging loan or development finance. He does the deal. He gets through the other side. He does a 20 block conversion. Bank win, tenants win, or whoever buys it. You guys win because you're loaning the money. You get 15% return, and then obviously Dr. Dan wins. But to answer your question, yes, you can. So for those that are new here, don't be scared of, if you find a deal and went to someone, it's quite common, this setup, but I'll teach you for free. People pay for this, by the way. If you went to someone, okay, look, I've got a really good deal. This is all the numbers. This is my build team that's going to do it. You put all the money in. I'll do all the work. At the end, we'll refinance it. You get your money back, and we'll go 50-50 on the profit. Who's going to say no to that? Who's going to say no? That's a really nice JV. You can have it all, so everyone's protected, but that goes back to what I just said. Time, knowledge, money. Three main areas.
Great. So just to kind of, how many of you in the room actually gets the picture of basically the investor gives you the money, the bridging loan gives you the difference, and then you either sell it, which is flip, or you refinance it at a higher value and pay the investor back their money? And how many of you kind of get that and you understand it? And how many of you then know and understand what that leads to? Show of hands. What does it lead to? It's just going to bring in the audience. What does that lead to? Who's confident enough to just one person? Just raise your hand. Capital appreciation. Free house on a capital property that's going to appreciate in value. Apparently, what a bridging loan allows you to do is to find the people with deep pockets, people who's got the money, and to fund your 25% deposit, which will be required, and pay your stamp duties and all the other professional fees in it. and then you pay back the bridging loan, you put it on a mortgage, and that means you basically own a free property that's going to, well, sometimes, most times, and every time, maybe, you can end up with a free property. But sometimes you can have some money left on the deal as well. Who here in the room have actually heard what we're talking about before? Show of hands. Great. So we've got a very good informed room. So Dean, moving away from that, there is also another different type of lending, right, or funding for property transactions, so which is the development finance. So can you touch a little bit on what does a development finance mean and how can people utilize it?
Yeah, so again, it's the same principle depending on the funding, but development's more depending on the size of development. You can be a developer but build one house. You can be a developer but build 300 houses, and then you've got development or conversions. You might have an office block to 20 flats or 50 flats, whatever it might be. So different development lenders will fund different levels of development. So most will go up to sort of 65% loan to GDV and like 90% loan to cost. But with I don't want to go too much into detail, but with development finance, you can get a certain percentage, maybe 70% towards the purchase or acquisition, depending on what it is. And then up to 100% of the work's funded, but up to 65% of the end value, and the surveyor will confirm that on the day. So, but they're going to want to see if you're a new investor and you want to do like build 10 houses, the lender will be nervous for you, unless you've got a good team. I know Dan's touched on this already, and what they mean by a team around you is, i.e., who's the contractor, what's his experience, does he have a CV, what's his company accounts like? Who's the architect? Who's the project manager? All these key people in a development are really key to get a development off the ground, especially if you're new. And also you've got things like mezz finance as well, it's like a top up. So it's like a secondary lender that will come in. Rates are quite high, but they'll give you an extra 10% or 15%, depending on the overall deal size. But development is a very broad term. I mean, also you've got Sam here as well, who runs a development company, finance. So, I've known Sam for a long time, but it's very broad. So it really depends on the actual transaction. You can have it very simply as converting a development into a HMO, 6-bedroom HMO, 6 en suites, 6 kitchenettes, still classed as development or more heavy refurb. So it's very broad. So depending on what you guys are or planning to do.
Great. So just to quickly touch, just a little bit of an explanation there. So HMOs, who here knows what HMO means? Okay, so for those of you who don't know what about HMO, HMO is house of multiple occupation or house in multiple occupation. It's where you basically buy a small house. So for example, right, you've got a small house. Actually, let me actually explain the strategy. Let me just explain what it means. So it means 6 unrelated people living together, on a room by room basis, sharing kitchen, bathroom, and the common areas. So that is what an HMO means. Okay, so if you're going to rent a house that is occupied by 6 people, all right, lenders usually have good appetite for it. Number one is 6 streams of income because 6 people live there. So if you buy a house that is so for example, you buy a house that is a family of 3 living there, versus when you buy a house and you have 6 tenants living there. So lots of lenders do have appetites for HMO lending, and most times high street lenders usually don't really like HMO like the Barclays, HSBCs, and NatWest and Lloyds. They like to lend to people, rent it to families, and while you have specialist lenders who lend for this particular purpose. So moving away from development finance, which you obviously explained, development finance is to obviously develop bigger projects. Let's go into refurbishment finance. So just if you want to share what refurbishment finance is and how can people utilize it as well.
Yeah, so it's not too dissimilar to development finance. You may, you get some, especially if you're new, you're starting out, you're going to buy a property maybe 100 grand, 150 grand, you're going to spend like 40, 30 to 50 grand on it. It may, it will uplift the value. So say you bought it for 100, spent 30, be worth 200. But sometimes if you're starting out, even though it's a low value number, you're still going to need a lot of capital, a lot of cash to get it going. You know, you're going to need at least 25 grand just for the deposit plus cost plus interest if you'll service it. But you'll get a lender that will go, okay, so you're going to spend 30 grand on it. We'll give you 70 grand towards the purchase. We'll give you the 30 grand paid to you in arrears as you progress it, because we know that it's going to be worth 200. So that means you're only going to put in maybe 40 grand. Because otherwise, if you buy property for 100 grand, you've got to put 30 grand in, and then you're going to spend 40 grand on it, or 30 grand. Well, hold on a minute, now you're up to like 60 grand or 70 grand. Not everyone has 70 grand or 60 grand lying around in their back pocket, but you might have 40 grand. So that way, if you get refurbishment finance, where a lender will give you the money to cover the refurb, paid in arrears, so it might be like 3 drawdowns of 10 grand, that's going to help you, right? Yeah, especially the new investors. Even if you're experienced, you may not know about some of these quirky little things you can do. Or some people will just go, look, I want to get a bridge. I'm going to borrow the rest of the money from someone. I'll give them the return, and that's it. There's lots of ways to do it. The most thing really is if you're new and you want to make money and you want to get in property, is to take action. If you don't take action, it's not going to happen. You know, who here actually spends a couple of hours a week looking at property? Yeah, spend a couple of hours. Who here goes and views properties a couple of hours a week? Who here asks for deals? Does anyone ever ask for a deal? I'm looking for a deal. Who here actually asked for a deal? If you ask, you'll be surprised. There's a lot of people out there who've got deals on their plate that they may want to do. They'll share it with you.
Absolutely. And who here asks for money? So who here is bold enough to ask the next person down with you and say, have you got £100,000 in your bank and you can loan me? Honestly, who here? So it's all about asking questions, right? And obviously having information and taking action. So I'm going to ask 2 more questions about finance, and then we'll probably open up the room for questions. What is equity finance? You know, and how can people use it?
So I'm assuming you probably mean people. You know, if you've got a background, who's got a home? Everyone got a home? Yeah. Who owns their home? Yeah. Most people own their home. So a lot of people are sometimes sitting on a big pile of cash, literally sitting on it, and they're going through, I want to get in property, I've got no money. But they might be sitting on £500,000 house with a 100 grand mortgage. So you're technically sitting on, from a finance point of view, you're probably sitting on 250 grand, 225, 250, that you could raise from your home pretty easily as well. So equity finance is basically that. You know, you're using your home asset, the equity in your home, to raise cash. So again, when people do that, I will do some due diligence on your deal for you. I will check it out. I'll make sure the numbers work, because there's nothing worse. And you will see it, you'll hear stories that people take cash out of the home, do a deal, but they haven't done enough due diligence on the deal. It doesn't stack. The market tanks a little bit. You know, it has a little drop. You have a bit of COVID in the mix, and then they're stuck. They've got taken a load of cash from their home, and they can't pay it back. So most people are sitting on a home with equity, which you can use to take cash out to then invest in property. As long as the numbers stack, that's the main thing. As long as you do due diligence, then there's no harm in it.
Definitely, property is a numbers game, isn't it?
Yeah.
Okay. I'm going to paint a case scenario. Someone has £1 million sitting in their assets. The property is worth 1.5 million. So it's worth 1.5 million. They got an outstanding mortgage of 500,000, £1 million equity. Apart from the fact that they can release some equity to buy a property for themselves, can they also use that to invest through someone who's got the knowledge, somebody who's got the deal, and create a joint venture partnership? So for example, they can use that as security, okay, as a deposit, to fund an ongoing purchase that would allow them to refinance and then pay back that equity or charge that's been put against that equity that they have in their house.
Yeah, so again, it would depend on the person, if they're going to be involved in the company as a shareholder. I'd probably suggest to have, that sort of structure, so then both people are more safe. But yeah, you can do. There's no harm in that. But obviously the deal's got to stack.
It's got about numbers here.
Yeah, it's all about the numbers. So obviously if you're borrowing at 12% and you know in your home and you're lending out 15, it's probably not worth it.
Yep.
It's too tight, I'd say. You're not going to borrow 12% and then lend out 15. That's just, I think that's silly. But yeah, obviously you can do that. Absolutely.
Great. So Dean, final question before we go to the audience. So a lot of people see property as risky, but then again, a lot of people take second charge loans and they spend it on things that I would call liabilities. So meaning like holidays are liability, because once you're back from that holiday, you know, who here has actually taken a secured loan against their house and went on holiday? I've seen people do it. Don't be shy. Who here has applied for a credit card and actually went on holiday? Show of hands. Don't be shy. Yes, you're honest, right? Good man, good man. So you do have people that actually do crazy stuff like that. Take on a security charge on their house and go blow that money. Take on a credit card, go on holiday. So what we're trying to actually do here is to kind of show you a few wealth creation strategies around the conversation we're having. How you can actually leverage your existing home, how you can actually raise private investors finance, and how you can bridge the gap. The bank are actually willing to lend, right? So you've just heard that you can actually borrow money from someone and use that as a deposit, get a bridging loan involved in it, get a mortgage after the value of the property has gone up, refinance it, pay your investor back, okay, and then you own a house that could be possibly free of charge. Obviously, this takes a lot of knowledge, risk analysis, all right, because you don't know who's in the room, all right. So it's very important that we echo that. You have to analyze your risk, and ladies and gentlemen as well, this is not financial advice, okay. I hope we're clear on that. Yeah. Risk is something that often people are very negative about. So people will be like, oh no, I don't want to borrow money to or re-leverage my assets to building wealth, which means buying properties. You and I both demonstrated a case study just now. You bought a house for 100 or something thousand, got sold for 200 and something. A property that I bought for 250, worth £800,000. So we can clearly see the wealth creation formula there. So property's time is risky, but it's a risk that definitely do have reward. So Dean, in closing, before bringing the audience, so what would you say in terms of good debt and bad debt, and how can people literally rewire their brains to actually learning how to leverage finance to creating wealth?
Yeah, I mean, risk is done internally, isn't it? You've got to know what your why and why are you doing what you do? There's no point having, you know, millions of pounds worth of debt if it means you've met your personal objective. Once you know your personal objective, you've got to stay focused on that. I can give you an example last year, and I'm probably quite risky. I bought a property at auction, another one came up on the street, the site, second street down, and I thought I could probably make that work. Won it, I completed, and I had like £2,000 left in my bank. I've just bought two houses, and one's just finished refurb, and I had to refurb the second. Now to some people, and bear in mind I'm two bridging loans here, some people wouldn't want to be in that position of, you know, competing on two houses and having a few grand left in the bank. That might be too risky for them. But I knew that one's done, one property's done, so there's no cost on that one. I can refinance that. The second one, you can just play things out, especially if you've got a good relationship with your builders. Get it done and say, all right, once you get to the end of the month, I'll get you paid. And what happens at the end of the month? What happens in life at the end of the month? You get paid from where? You're working, right? But again, it's risk. You've got to take some risk for the reward. But understanding your level of risk is you've got to decide that. And that's where the JV scenario comes in really well, because you're putting the reward for your objective is, if I get this done, we're both going to make £1,000 a month. But your risk is you don't want to lose a deal, but you're not putting any equity money into it. You see, there's different levels of risk, and everyone, some people don't ever want to invest, and that's completely fine. It's, whatever makes you, happy. But as Dan said, property does go up on average. I mean, I think the Halifax index said property prices went up this month. Or was it last month? It went down a couple of months ago, but it went up again this month. So even though the rates are really high, still high, property is still going up. We're not building enough houses. We built 220,000. That's 60% target this year. So we're just not building enough. The population is increasing. We expect the population to increase considerably. You've got to look at the external factors as well. Obviously you've got to buy in certain areas that there's always going to be demand. And I don't think you can go wrong. And rent as well goes up. So where you buy net like 5 years ago, and you're basing your numbers then, rent goes up. It doesn't stay static. It always goes up. It goes up in market conditions. If pay goes up, rent goes up, usually. And we're not building enough houses. So then you've also got the other side where you've got the older landlords where they just don't like labour for some reason. They're worried about that. They'll sell a load of stock. We get to that sort of age point. So they reduce the supply. What that means is there's more demand. So again, increases the rent. So I just don't think, if you're new to investing, get clear on your objective, really, really clear, write it down why you're doing this. Because if you don't know your why in the property game, then it's pretty pointless. I'll tell you mine. I started obviously many years ago. I just wanted to do 4 deals a year and make £400 per property and get my money back out. I've been pretty consistent at that. I'm now going into sort of multi-unit blocks. The last deal I did, bought it for 198 grand. We spent 45 on it. It was a block of 2 flats, 2 bedroom. We split title, create leases. It was valued at 350. We completed it last week. All money out. But that's taken a bit of time to get to that stage. I can spend some time on title split, where you don't have to pay stamp duty or CGT, capital gains tax. There's loads of little nuggets in property that you can really create wealth, but in a really efficient manner as well.
Great. Thank you so much for answering that question. So we're going to go to the audience now. I'm going to take 5 questions from the audience, and we're going to take a quick 2 minutes break, and we'll be back on the next session of the conversation. So there's your question.
I'm Viresh. That was Dean. That was very insightful. My question is around refinancing mortgages, and I don't know if you'd agree, and I just wanted your views. And I think we're on a very slippery slope today because of the fact that when it comes to refinancing mortgages, especially in the market today, with the increase in interest rates, I mean, homeowners are going to have a fair amount of difficulty, because what I find is a lot of banks are basically, and because you're in finance, real estate financing, have you come across banks who are changing their products, the nature of their products? So what effectively is happening is that it's becoming more and more difficult for homeowners to refinance because they're having to cough up more capital at the point in time where they're refinancing the mortgage. So, I mean, maybe it's a function of property prices which have depreciated over time because of high interest rates. Obviously, interest rates coming down will really help the situation. I mean, they probably have peaked. But this is an issue which I think homeowners are going to face. I have faced this situation in terms of banks changing their products, so that just completely changes the equation, and then the homeowner is left in a lurch in terms of trying to come up with that excess amount of capital. So I think maybe a lesson to be learned is, if you have probably more equity, stick it in. Don't listen to the banks, because the banks are going to try and give you the best deal. But if you have more equity, invest that. Would you agree with that?
Are you referring to, is that like your home mortgage or investment mortgage?
Home mortgages.
Home mortgages, yeah.
Well, you see, the banks, whether it's an investment mortgage or a home mortgage, if the bank changes their products and they start, tinkering with loan LTVs, then it's going to be very hard for homeowners or investors to refinance their loans and mortgages, because then they'll have to cough up additional cash. So I think that is an issue which I've encountered, there are some other people who are encountering, a number of banks are changing the nature of their products, and they're becoming more and more conservative in lending because they see the value of properties going this way and not that way.
So, in my experience, once you've locked in a deal, the lender will honour that for 6 months, generally speaking. That's my experience. So if you've had a personal experience that may be slightly not similar, I guess I can only apologise, because generally speaking, they will honour that deal for 6 months. The only way they will not honour it is if the valuation expires, or it's not a proper bank, it's some backstreet bridging lender, then that's obviously something completely different. But generally speaking, most banks and entities will honour that for 6 months, if it's been locked in.
I think my question was not around the banks honouring it. My question was around at the point of refinance, because every mortgage will need to be refinanced at some point, right?
Of course, yes.
Because the maximum tenor is 5 years. I don't know, correct me if I'm wrong. So people have financed their mortgages for 2 years and then they refinance, or they do it for 5 years. The point of refinancing the mortgage is where the homeowners are going to face difficulty, because the banks are changing the nature of their products. So banks are becoming more and more conservative, and these are big banks, these are not the smaller banks. So I think the lesson, probably a lesson to be learned, and I don't know how we can mitigate that sort of risk, but it is to put in as much equity as possible, because if something like this happens, then you're not left in a lurch, you see. Then you have to then cough up additional capital, which makes it difficult.
I think what you're referring to is, 5 years ago, you're probably on a 2%, 5 years later, you're on 4.5%, 5%. So that naturally does impact cash flow, because if you're paying 1,200 quid a month, you'll go up to 1,800, 1,700. So then you're suggesting if you put more capital in, then the payments will be the same, 1,200 quid. Yeah, I do agree with you. But if you can get a better return elsewhere, then that's obviously, you've got to decide that. If you're a big-time property investor and you can use that money, recycle it, make a £500 a deal or £8,000 a deal, then you offset what your day-to-day costs go. So again, that comes back to attitude to risk, deciding what works best for you.
I mean, just to add to that, so this is part of the conversation that we were trying to have at the beginning of understanding the mindset of a property buyer and the mindset of a property investor, right? So, and I'll probably want to answer this with a case study. So if you're going to buy a property that's worth £400,000 and you're going to have to remortgage your house to release equity to buying that property, all right, and then the property that you're buying is going to be rented to a family, and the family that you're renting that property to is probably going to pay you the standard average rent in the market. And now you're buying around that property to rent it out to a family. So, and the value of that property, regardless of the value added, significantly, right? The value you've added onto the property will not be taken into account, because it will be valued according to the other properties on the same road. But in a situation whereby you're leveraging against your current home and you're raising finance, and then you're buying a property to turn it into a house in multiple occupation, 6 tenants, higher yield, higher returns, higher capital appreciation. So you have the opportunity for leverage that covers your cost of finance, even as of when you are refinancing, regardless of what the market could look like. So I'll give another case scenario. So we basically did a transaction, right? So we bought a house 4 years ago during the pandemic. We bought it for 450, fixed it for 2 years at a very, very low amount, very low interest. So got it fixed for 2 years, bought it for 450, all right, in 2000 during the pandemic, in the middle of the pandemic. And the interest rate was, the mortgage was about £1,850 per month. The property gets revalued for about £850,000 to £900,000. 2 years later, after the pandemic, interest rates goes crazy. Mortgage of about £1,800 goes up to £4,000. However, the property value also goes up. Okay, so the mortgage is expired. New mortgage is £4,000. However, the mortgage is gone to over £1 million. So I'm able to remortgage the property, still take some money out. Okay, interest rate is high, but I'm able to release at least between £70,000 to around about £100,000 out of the deal. the mortgage payment is £4,000, the rental income on the property £7,000. So if you do your maths correctly, you're not literally in any sort of risky situation here, because if you tick all the boxes, whether 1 to 3 or 1 to 4, your cost is being properly covered. One, rent gone up. So in 2020, the property was producing less than £6,000. 2023, the property is producing £7,000. Rent is gone up. In 2020, the properties were £850. 2023 properties were over £1 million. Do you see how that's been covered now?
The homeowners are going to suffer because they are renting out their property. So the same bank who you are refinancing the mortgage with are going to change their loan to value because they are reducing the value of the property. So the homeowner has to come up with additional equity. You see, this is where the problem is, and I think there'll be a lot. I mean, I think we're on a slippery slope here. Unless the interest rates come down, or the regulator does something, or the government does something to protect homeowners, we don't have a major issue. Because the banks are saying that, sorry, I can't give you 75%, I can only give you 60% because the value of your property is depreciated.
Thank you so much for that contribution. Yeah, it's an issue. Well, this is why it's very important for you to get into property with the mindset that is very super creative. The people who are making money now in real estate are people who have super creative mind, super creative team, whether that being builders, finance, solicitors. I'll tell you something now. I'll go into a 2-bedroom property and I'm seeing a 6-bed house. We have converted a 2-bed tiny little house into a 6-bed HMO with a nice, massive communal space, right? But this is something that, if you really look at it in the eyes of anyone else, it's absolutely impossible. So this is why it's so important to be super, super creative and have super creative team around you. So I think I'll move on to the next person for the next question, and we can have a chat with myself or Dean later. So take the question from the back, please.
Hi there, my name is Ali. So what I'm curious about is, let's say from your work, whatever you've saved up, you've got a cash of 100,000. So with the market now, are you better off going up north, buying cash if you can and renting it out, or you stay around London, which you can't do much with 100 grand, you have to get a mortgage or a buy to let, and then you owe money to the bank, but while you rent out. So either I have the 100 grand, I go up north, buy cash, and do something, for example, split into 2 flats or whatever you can achieve, because it's cheaper. I stay around London, and then now I've got to work with the bank, have a mortgage, and work around that.
Go first.
It's a really good question. It goes back to your time. What time have you got? Because if you've got more time, you can go further afield, but you can also go to places like Kent. And you can get a lot of deals in London for over 100 grand, by the way. Low lease flats. Who knew or who realised the law changed 2 weeks ago? Leasehold reform? Yeah? Does anyone know some benefits of it? No, you can extend leases, you don't need to wait 2 years. Marriage values have dropped by about 40%. What does it create? What's it creating here?
Lease extension.
Yeah, but what's the word called? Opportunity, bang on. So, there's loads of flats in London that are low lease. So what can you do? Buy them. What else can you do with a flat? If it's a 1-bed, maybe put it into a
2-bed.
2-bed. There are loads of things you can do in London, and then also you've got Kent as well. Kent's obviously big, and Kent's not too far, but there's loads and loads of opportunity. I can let you into a little secret. If you created a website, say we buy your house cash, do some target marketing, maybe in London, do you think you'll get some inquiries come through? Yeah? And with bridging, you can go on market value. You're buying this property cash. So you'll get inquiries, I promise you. It might go on for 200 grand, but it's worth 300. You could go off the 300 value. Anyway, I'm going off and spitballing here, but to get to back to your point, yeah, there is loads of opportunity, but it depends on what you want to do and your time, and specifically. You can do loads of stuff up north, but it's more time because you've got to travel up there. You can use things like Viewbar and other things.
If I want to rent it, not flip it, for example, and I know the yield is better up north apparently from what they say, so is it better going up north than buying cash?
It's a really good question. I'll just
Okay.
Yield and cash flow. What's better actually for everyone? Cash flow, bang, yeah. Because you could have a high yielding property, but it's making you 200 quid a month. But you could have a property that may be lower yield, but you refinanced it, it's in London, you refinanced, got your money, but it's making you 10 grand a year. What are you going to want? So it's making you 2 grand a year or 10 grand. Yeah? And I tell people this, don't focus on yield, focus on cash flow. That's what's important on a deal. You know, if you buy it, you turn it into 2 flats, you refinance it, and you get your money back, and them 2 flats now make you £600 a month after the mortgage with the current rates. That's a much better place to be. Like 100% better to be. So always just change things over. You know, don't focus on yield, focus on cash flow. If you can make a good amount of cash flow in the current rates, what's going to happen in the next 3 to 5 years? But what's going to happen with rates, we expect? Go down. So if you're making good cash flow now, when you go to refinance in 3 to 5 years, what's going to happen? It'll be a better place. I've got clients literally just buying as much stock as they can in London. Most of them don't even care if it makes a huge amount of money. They just want them to cover. They literally just want to make sure they cover it, get the money out the deal. They're still making money because rent prices in London are crazy at the moment. They're still making money, but they're just trying to buy as much as they can because it's still a buyer's market. When that base goes down, the confidence, everyone's going to come out of the woodwork. The doors start opening, people start getting a bit more confident.
Yeah, just to quickly add to that, you mentioned cash buyer, right? So I'll give an example. We run a property consulting firm as well within Property Wealth Corporation, where we help people buy property hands off. All right, so we do the refurb. We work with the power teams. Obviously, Dean is our financial advisor, part of my power team. So property bought for £50,000, cost, refurb, professional fees, and everything else, 40k.
I own a construction company, so I'm not worried about the refurb.
Okay, so I'm just give you a number. So now you spend what, £90,000, including stamp duty and everything else. Property revalues for around about 130 to 150,000 pounds. Okay, and you refinance it, you're able to pull out probably 80,000 pounds of your total cost. So basically, for £10,000, you own a house that's paying you £300 to £500 if you're lucky. Well, sometimes people do. £300 to £500 per month. So times that by 12 on £10,000 is better than actually money that you have in the bank. So in terms of cash purchase, you can go out to up north and just do that without using bridging finance to do it. But obviously, if you're buying properties in Kent, £100,000 means that you're going to still you're going to need a bridging loan to do that as well. So I hope that kind of give you a 2-case scenario. So yes, £100,000 can serve as a deposit, but you're going to need a bridge to buy a house in Kent.
Okay.
But up north,
100,000 is a good amount to work with. It's a good
100,000 is a good amount to work with. So whether you're going to buy, at least in Kent, you need that as your, depending on the kind of house you're buying as well, isn't it? So if you're buying a house that is 300 to 250, that's going to serve as your deposit, your professional fee, stamp duty, and all of that.
Yeah.
So I hope that answers your question. Great. We got 3 more. Okay. We got the lady.
Hi, my name's Kaylee. I know you mentioned about the second charge mortgage, so I was just wondering if you've got a home already, is that quite easy to get? Is it a long process? How long does it take?
So yeah, it's a good question. So you've got second mortgages, or you've got equity mortgages. There's 2. So you can get there's a few things. You can do a further advance with your lender. That's the cheapest. So you can get that, then it's always cheap to do the cheapest option. So depending if you might be with Halifax, your home's worth 300, you've got a 100 grand mortgage. Depending on income, it's income assessed rather than just the property value assessed. You can then raise X amount of money based on your income, and then you just pay a second mortgage essentially. The second option is a second mortgage, like a second charge. Again, it's another mortgage that runs concurrently along your existing. Again, it's based on the value, it's based on income, but there's some quirks. So then we do some slightly higher loan to income to loan ratio, so you might be able to get slightly more. And then also the third is the equity charge. So there's 2, so you get a bridge, which is a second charge mortgage, just based on the value, just they don't care your income. And then your equitable charge, which means they don't need permission from the lender. Some lenders don't grant second charges; they just say no, we don't do it. So then a bridging lender might go, we'll do an equity charge, costs more money, but they don't need permission. They'll just put a charge, an equitable charge on it. Does that kind of help? Yeah.
All right.
All right.
Next
Hi.
question.
Yeah, hi, Dean. Yeah.
Your name?
Sorry, my name is George.
Hi, George.
Yeah, hi. I think you probably touched on this slightly. I don't know if you can probably expatiate on it more. Let's say you want to buy a house, and the house is definitely run down, and there's no mortgage. The vendor doesn't have a mortgage on it. Yeah, I think Daniel has told me something about vendor's finance. So I don't know if you can expatiate on that.
Yeah, it's really good point, really good question. Again, it comes back to JV. So this is a JV opportunity potentially. You get a lot of people again. They have what are the three? What's the three we said? Time, money, knowledge. This might be a perfect example. He may have this guy might own this house, but he has no time, and he's got plenty of money. But he likes you. He's got along with you. So what you could do to him is go, look, let's do a deal here. I'll do an option agreement. I agree to give you 300 grand for your house, bit in 12 months. You then refurb it. You then sell it on for 400, and then you give him the 300. Or you could go, okay, let me take all the headache. Let me deal with it. You've got this house, but it's got planning to build another house. Okay, so you can do something called deferred consideration. So you can say with Mr. Smith, right, we'll set up an agreement, deferred consideration, we'll get finance on this, all right, you need 200 grand to build the other house, but then both will sell for 400 grand each. Once it's done, we'll split the profits 50-50, but I'll do all the work, all the headache. He's going to say yeah, if he hasn't got the free things, free time, knowledge, money. So there's loads of ways of structuring things, it just depends on the person who it is. And the biggest thing is ask. If you don't ask, you don't get. You'd be surprised what people will say if you ask, and they like you. If they don't like you, then you've got no chance.
Okay, we'll take one more.
Thank you. It's probably just to piggyback on a few of the points that you've already raised, but you mentioned about in the beginning you're not necessarily an investor if you've got like a those shared schemes, and then you bought it that way, and then you want to invest it and then rent it out that way. What are the downsides of people who, let's say, have a consent to let on their property, and then are now using it, got it on the bank, renting out that way? What are the downsides on doing it that way? What are the things that they need to consider if they're also trying to get into investing within property?
Yeah, I mean, consent to let is a good thing really, because you technically are investing in property. The downside is, depending on the lender, they might load it. A lot of lenders now are, some lucky people may be in here, they might have got like a 10-year fix at 2%. I did someone's lifetime mortgage at 3%, 35-year mortgage. Quite nice. But anyway, but they load it. They'll load it with 1% premium or 2%, depending on the lender.
I got mine unloaded.
Yeah, so there you go. So they'll load the premium. So then when you come for renewal and you're probably on repayment mortgage, it then shoots right up because of the rates. But what you probably want to do is refinance it onto, if the numbers work, onto just a straightforward buy-to-let interest only, majority of the time, because that's best for cash flow. That's like the biggest risk with consent to let. It's not really, there's no risk when you're on a fixed period and it's all honky-dory. The biggest risk is when it comes to an end, because I'm working with someone now, they're paying $3,300 a month, the rent's $3,600, the mortgage now has been up to $4,800, even on consent to let, because it's loaded, the current rates just doesn't work. Like, you're not going to pay, well, they may want to pay, but they don't want to pay an extra £1,200 a month on top of it. It's too risky. That's the biggest risk.
Great. Thank you so very much, Dean. We will be coming back to another Q&A just probably after we take this little break. But just before we actually give Dean a massive round of applause, please. Don't go yet. Okay, so I just thought I'd share this very quickly, right? So from time to time, a lot of mortgage brokers or financial brokers, you have two types of brokers, right? So you have the one who just submit applications, all right? So you want a mortgage, they give you a mortgage, all right? They just submit the application for you and get your mortgage. That's their job. Ideally, most mortgage brokers, that's what they do. But you have a mortgage broker who is a property investor himself, all right? And who does different types of strategies. And as well as you have brokers who are super creative, all right? And they become super creative because of the kind of complex cases they see from time to time. So I mentioned at the beginning of this conversation, Dean here has been a good friend. Basically, the Ramsey and White team actually saw all of what we have today grow. So we've been partners for at least my entire property career. And a lot of lenders, a lot of brokers are basically not creative. All right, they submit an application for you. They're not there to coach you. Yeah. They're not there to mentor you. They're not there to advise you what way to go. And then you have a lot of estate agents, brokers. Again, they're just trying to sell you properties, all right, that you're buying from their agents, and that's it. They're not there to really look after you. And again, they're not there to teach you how to create wealth. All right, and I can go on and on in different case scenarios. So Dean here, we've been working together. We've helped, so many clients, individuals who have been part of what we do. Now, just before we go, before I obviously usher Dean off the stage, is previously we run a company called Property Wealth Education. Right, Property Wealth Education was a platform where we sell courses and mentorship programs. So you buy our courses, our programs, you learn, and you go and do your thing yourself. Okay, but we basically relaunch this very month, where we have turned it from a property coaching and educational platform to a private members club. Okay, so in this club, you basically get educated. You have coaching, you have mentorship, you have collaborations, you have network, you have so many different types of things. I'm going to be talking about it later. So there we have different types of masterclasses that do happen every now and then, so you actually stay up to date. All right, and not just stay up to date, have the people that will do it with you. Okay, and then the power team that you need at every given stage of your journey. So I'm going to be talking about it later. So any one of you who are interested can basically, register your interest, and once it gets launched by the end of the month, you can join us. All right, and you can have, not just have, you can have access to Dean now, but it's not there to blow your mind. But by being in the community, by being in the club, you get your mind blown up, and you get to really learn so much creative ways. How I personally, so I didn't have money at all 7 years ago to start property, and over the years I've raised at least £2 million in just under 4 or 5 years. I've raised at least £2 million. Has allowed me build a significant property portfolio. We have, very large portfolio of tenants, and working with people like Dean, all right, being creative allows us to navigate different complex, finance options that are out there. So do stay in the room to network, and then we're going to talk about, all the creative finance, which I'm going to be talking about. So Dean, thank you so much for coming. So Dean, I forgot to ask you about your company, Ramsey and White. So do you want to just share a quick light on Ramsey and White?
Yeah, so been running now for about 7 years. So a specialist brokerage firm. We cover everything from residential to development, everything in between. We've also got a wealth management, which is protection, pensions, investments, proper financial advice. And yeah, the brokerage is really good. We just opened a new office down in Cardiff, 40-man office. So we've got a really big team there, and it's growing. And we I genuinely care for my clients, and I spend a lot of time with clients because I do genuinely want to, as I said, you win, I win.
Yep.
There's no point in you doing one deal. I want to do lots of deals. one of my biggest clients, we seem to do like 1 to 2 deal a week because he's buying a lot of stock. And I will share all my knowledge with you, you know, especially in property investment, little tricks and tips, little things that I do, things that I've learned along the way, which really helps. And especially like the title split, you know, creating leases, that's becoming more and more popular at the moment. And I've just done it, so I know the process in terms of how you set up 2 companies, how you get the shares to link to the companies, how you don't pay any stamp duty, no CGT, get the freehold in one, buy it in the other. Loads of little tricks which help yourselves. But thank you anyway. So thank you so much for having me. It's been really good.